Your ETF might be costing you more than you think, not in fees, but in taxes. Sofia Massie is CEO of LionShares and joins us now. Sofia, great to have you here.
It's great to be here. Thanks for having me.
So this is an ETF Spotlight. The fund is TOT, LionShares US Equity Total Return ETF. We'll get into that in just a bit. But first, as we near the end of tax season, I think this is when investors really might start to notice this. ETFs are often marketed as tax efficient, but it's not always the case. So tell us what's catching people off guard right now, Sofia.
Absolutely. And we all know that the ETF market has absolutely, blown up in the last year. We've seen a huge proliferation of new funds and new strategies. With that, though, comes some awareness that investors need to have about exactly what they're holding and what the tax implications of that might be, particularly for any ETF that has a high yield or, an income generating strategy. Investors may or may not be fully aware that that income that's being generated oftentimes, could be considered ordinary income, and that's potentially being taxed at your regular income level, potentially being taxed at the city, state, and federal level. So those high yields that you're, seeing may be actually much lower once you consider the net effect of taxes. So, that's something to just be aware of as you're making those investment decisions, and talk about that with your tax planner, with your financial planner, and just make sure you really fully understand what it is that you're holding and the after-tax returns that you're really seeing.
I've seen taxes described as a silent fee, so that makes sense. But for a regular investor holding something like a broad market ETF, how much of the return could actually be eaten away by taxes?
Absolutely. It's really dependent on, the exact location of the investor, their tax bracket, but generally, just to take a step back, the reason ETFs pay out taxes to begin with, it's because they're holding, investments that generate some sort of income. So for a broad market ETF, usually those ETFs are collecting dividends from those companies that they hold. And then in order to basically satisfy the rules of ETFs, those dividends need to get passed through to investors. So for the broad market, generally that might be something like a 1.3% yield every year that's associated with dividends. In terms of how much, investors are actually keeping at the end of the day, that type of dividend is going to be likely considered ordinary income, which means that if you live in an environment where you're paying city and state taxes, you'll be paying, those taxes on top of your federal income tax. So, if you're a high earner living in somewhere like New York City, where it's a bit more punitive, the tax situation, you might be paying something like a 35% net effective tax rate on those higher income tax bracket individuals. So you could be losing close to 50 basis points a year potentially on a broad market holding. And that really does actually compound over time, over a 10-year period. That leads to lower returns that are on the order of 12%. If you're saving for retirement, the compounding effect, that's an exponential effect right there. Over 35 years, that could be 700% lower returns that you're experiencing on a broad market holding in that tax situation. So if you're investing $100,000 today, that means 35 years from now, you have $700,000 less than you could have due to this tax drag effect.
So as we think about these distributions, if you will, you mentioned dividends, but what else could they be? Capital gains? What else should we be thinking about? And I guess, why do ETFs pay out distributions at all?
Yeah, there's lots of potential income generating activity that could cause an ETF to have a dividend. We see that ETFs usually don't pay out a capital gain dividend, although there are edge cases where it might occur. And that's sort of, the benefit of ETFs compared to something like a mutual fund, where because of the unique way that ETFs rebalance, they're able to sort of minimize the amount of capital gains that they experience, and thus, avoid the need to pay out a capital gain dividend to their investors. So that's part of why we've seen this massive inflow, of assets into ETFs away from mutual funds. Almost the entire growth of the ETF market actually can be explained through outflows from mutual funds. So that's kind of one of the key things that's been driving that. But there are lots of different ways that ETFs can generate income within their basket. It could be something like an options overriding strategy, something like a swap holding that is generating returns, something like collecting dividends from ETFs from other funds that ETF is holding, from other stocks that the ETF is holding. So there's lots of different ways that an ETF might be generating income. And that could result in either a capital gains dividend, which is slightly less common, but does still happen for certain, particularly advanced strategies that might have unusual holdings. But more typically what we're seeing is an ordinary income dividend coming from some sort of income generating strategy that the ETF is performing. And oftentimes, those ETFs are actually intentionally trying to generate income. So the fund managers may just have a completely different goal. So really at the end of the day, it comes down to what that investor is looking for. Is this an investor who is saving up for retirement for many years and wants a more efficient product that will keep their assets invested and avoid that tax drag? Or is it an investor who wants that income day to day, and they don't mind taking the tax hit because they'd rather see the income earlier? At LionShares, the perspective that we have with our new ETF TOT, which provides the total return of the total market, is that we think there aren't enough products out there for those long-term investors, and we want to give control to the investor over when they want to receive that income. So, if for most ETFs you're kind of just at the whim of whenever the ETF decides to pay a distribution, but we aim to pay no dividend to our investors, which then means that the investors are able to choose when they realize income by selling off some of their investment at their choosing, or if they are just saving for retirement or saving for many years and don't want the income right now, they want to minimize that tax drag, they're able to really efficiently hold on to that investment in the total market without receiving any distribution, and really getting that access to the market in a way that no other ETF really provides at the moment.
So if I'm investing in your ETF, TOT, to help improve my after-tax returns, what am I investing in place of?
Yeah, it's meant to be, a replacement for other broad market ETFs that, are a huge part of the ETF industry already. Something like VTI or ITOT have very similar economic exposure to our ETF. However, those, like I mentioned, are subject to distributions and may experience more tax drag. So our ETF is really meant to replace those other broad market ETFs and be sort of a core holding in a portfolio that you hold for a really long time. And, I think everyone has some way to access the total US market. That's a very common holding in portfolio. So it's really meant to be a replacement for some of these older ETFs that are currently providing broad market exposure, and just really modernizing that holding and making it much more efficient and much, more attractive for long-term investors.
But then does the fee that I'm paying to hold your ETF kind of cancel out the after-tax savings, if you will?
Yeah, so we've done the math on our end, and we think that there's definitely investors where, the net effect is positive, but that'll obviously depend on everyone's tax situation, so you should consult with your tax planner. But I think there's definitely still some room for benefit based on the management fee that we have. We charge a 7 basis point net expense ratio at the moment, so we're trying to be really competitive. We understand the fees that other ETFs are charging and want to make sure that we're competitive in that market.
Okay, so bottom line, if I'm just a regular investor looking at my account right now, what should I actually be paying attention to before I buy an ETF?
Yeah. I mean, we're in the middle of tax season right now. Everyone's getting those 1099s from their various brokerages, and I myself sometimes am surprised to see the amount of income that my holdings have generated and the taxes that are due as a result of that. So now that we're kind of in this reflective period of the year, I think everyone should look at your holdings and see what's been generating income, whether that's income that you want to experience now or whether you'd prefer to keep your assets invested in the market in a way that doesn't generate that income and then lead to a tax effect later on. So just understand, when you see something that's a high yield, really how much of that are you keeping with the after-tax return? And I think, this time of year is a great time to do that because we're already looking through all of our tax filings already.
Sure. All right. Well, we will leave it there. Sofia Massie, CEO of LionShares. Thanks so much for shedding light on this and your fund. Really appreciate it.
Absolutely. And like I mentioned, there's more ETFs than ever right now. So, it's really easy for investors to get confused and not fully understand their holdings. I really do think this is an important subject that we're going to talk more about as, ETFs continue to proliferate.
I look forward to it. Thanks, Sophia.
Thank you.